And today is your December 19th real estate lending rates report. I'm going to spend a few minutes today talking to you about what happened last week, where loan rates are for commercial properties, and even going to touch a little bit on residential. I also want to talk about an opportunity that I see because I think it could be going away. So let's start off with this. What happened last week? Well, on Wednesday, the Federal Reserve Bank came out and they published the minutes of their meeting, the FOMC minutes. And there were some data in there that got bond markets extraordinarily excited. They kind of plotted where they thought rates might be next year. And bond markets took that as a sign that the Fed was going to start cutting interest rates. I don't think that's true. To make things more confusing, the chairman of the Federal Reserve Bank, Jerome Powell, came out, went on CNBC and all the financial networks, and started saying, yeah, maybe we could cut rates next year. Again, we're getting ahead of ourselves, the keyword in that being could. Markets went ballistic. I mean, they reacted very positively. Bond markets have been looking for a signal that rate hikes are over and that rate cuts could be in the future soon. So because of that, I think if you follow me, you know I've been saying for years, whether it be on YouTube or on Facebook or here on LinkedIn, whether I've been saying that markets are discounting mechanisms, right? They don't always react. They try to skate to where they think the puck's going to be. So they try to second guess the Fed sometime. So they thought this was extremely positive. Investors started buying bonds. And when they buy bonds, interest rates start getting lower, whether it be for loans on commercial properties, commercial debt, or whether it be a home loan. So just to give an example of what's happened since the Fed came out and talked last week, I'm going to try to share with you what the 10-year bond yield has done first, and then I'm going to talk about what residential mortgage-backed securities have done. So let's see if this share works. It does, super. So what we're looking at here is we're looking at the 1 day. Let me change this and look back over the last month. Okay, so back around Thanksgiving, the 10-year Treasury yield was close to 4.5%, was 4.47%. Today, right now, as we speak, it's 3.92%. And you can see right here is last Wednesday. That's when that big drop in yield happened. And that's because you had a bunch of buyers coming in after the Fed, and they were buying 10-year Treasury notes. And when they go in there to buy when they buy Treasury notes, they pay higher prices, and therefore the yield drops. And that's how we price commercial real estate debt. Just to give an example, I mean, just in the last week, we see rates as much as 40 basis points lower. On multifamily, they're about 30 basis points lower. Just to give you an idea, for low leverage, 1.5 debt coverage, we actually quoted rates just below 6% this week. For strong credit tenants, for retail properties, or for industrial properties. Multifamily, we're seeing them, again, 1.5 debt service coverage ratio, low leverage. We're seeing rates just about 6 to 6.25 on multifamily. And believe it or not, in office, again, a good location, maybe 1.5 to 1.75 debt service coverage ratio, and low leverage, you could see office rates at 6.5 to 6.75. By the way, I mean, that was unheard of as recently as 10 days ago. And so that's the kind of thing that we're seeing in the commercial real estate debt market. Okay, so let's see. Let's do another little shot here, and let's see what happened over in the residential market, because I think that's kind of unique. Let's see what we saw in the residential market. A little technical difficulty here. Okay. Now, residential mortgage rates are track mortgage-backed securities. And what you're looking at here is, this is a 5.5% mortgage bond. So just a month ago, or right around Thanksgiving, that mortgage bond was priced at around just under 98, 97, 97 and a half. And today that mortgage bond, or yesterday I should say, it closed over par. So the mortgage bonds have increased 2.5%. Why does that matter? Because it brought retail mortgage rates down over 50 basis points. So just to give an example, my wife, who makes residential mortgage loans in California and Florida, she priced a VA home loan at like 5.5% today. She would have priced that over 6 right after Thanksgiving. She priced conventional loans today. I think she was at just over 6%, 6.25. That would have been close to 7% a month ago. So this is a positive thing. What have I seen? Well, gosh, I've seen this thing ring off the hook since yesterday. I have been quoting deals all day today for commercial properties that Matthews has listed from buyers that I spoke with over a month ago. And they're excited. They're back in the market. This is a positive thing. Now, here's what I think the bad news is. Right after Jerome Powell came out and gave his talk and suggested that maybe the Fed could be cutting next year, about 2 days later, the Federal Reserve Bank president of Chicago and the Federal Reserve Bank president of New York, they went on the Sunday talk shows and they started publishing things and were quoted saying, hey, what's this cutting rates? We're not done fighting inflation yet. I mean, the market's getting ahead of itself. Now, I think that the bond markets are dying to hear good news. And so they're almost forcing this. So I actually think this opportunity to lock in some cheap commercial real estate debt or lock in a low home mortgage is possibly disappearing in 30 to 60 days. So, if you're out there shopping for properties or you're looking to refinance debt, I think you've got a window that's going to be shut in 30 to 60 days. So take action today or before the new year because I don't think that's going to be there for you. So kind of in summary, what the Fed do, the Fed came out and said, hey, maybe we're finished. And then they backtracked. Different members of the FOMC backtracked about 3 or 4 days later and said, well, we may be finished raising rates, but we're certainly not cutting rates. So I don't know. Again, markets hate volatility. They hate indecision. They like predictability. So fortunately, the bond markets are still strong. The 10-year's under 4%. Mortgage-backed securities are finally trading at a premium versus they were trading at a discount pretty much for the last 6 months. So there's some good opportunities out there. I hope that gives you kind of an update. Again, if you have a really great property, a really great tenant, and you're not looking for the highest leverage out there, you could be locking in commercial real estate debt under 6%. And that, my friends, is a Christmas gift we all needed. Have a great holiday. We'll talk to you soon.